Eusebio is a master trader. For almost 10 years now, he's been using the Max method since Dr. Jim Pruitt started all this up, and has refined the Max method to take into account all the latest permutations in the way the market has actually changed. Things have been very quiet lately, so we have to be incredibly precise with our entries and our exits these days. And Eusebio has tightened things up hugely. And he's also gone on to develop another Max course called ETF, which, as well as trading the trend, also trades counter trends and small movements in the opposite direction for even more entries and huge profits. If I told you some of the profits that he'd make, you wouldn't believe me. But having said that, I know a lot of places say we make 500 pips a day or something like that. Very hard to do these days with some of these small movements that are around. But you don't need to make that much per day in the Forex if you're consistent with what you're doing. Just something like 30 to 50 pips a day is enough to produce a really good income after a little while using compounding effects. Even if you start off with a small account, you can still build it up really nicely. But if you follow Eusebio, you get some really amazing tips, very nice methods to trade with, and yeah, hopefully become really successful. And that's how we want to help you. Looks like you've started already, Eusebio. So I'll stop yabbering and get over to you. All yours, Eusebio.
Yeah, thanks, Chris. No, I was simply observing the market just for the London Open, and so I have realized that we had a max entry set up on the pound yen, one forming on the euro yen, but not a valid one. The max standard know why, and we have another one developing on the US dollar yen, but not a valid one too. So what I'm going to do during this session is, if we have some trades opportunities corresponding to the max concept and tools, I will, during the 2 hours we will be together, I will show you them. Of course, I will not give all the details how we define these trades. This is the object of the course. Next month, and for a period of 2 months, we teach 2 important courses, the Max Primer and the Max Standard. The Max Standard is our flagship course containing how all the subject, all the concepts and rules, how to trade the trend with our acceleration profit technique, which is the scaling technique, while we control the risk, of course. And the Max Primer, which is a very, very basic version of the Max, with simpler concepts, simpler rules, so simpler trades, no scaling. And I will use today the template we are using with our Max Primer course, and so it depends what the market will develop as a movement. Anyway, I would like also to explain some of the concepts we use in the Max. So every day, for example, when we use small time frames, and I like personally to trade the 5-minute time frame, but also the daily time frame, I prepare my trading day with what I call my daily preparation routine. And some of the steps of my daily preparation routine consist in studying the news release for the day and defining some biases on specific currencies in order to get some idea where the action can be present. For example, today, if we observe the calendar, let me show you on Forex Factory. We are Wednesday 22. We have in a little less than 1 hour now. All these time schedules are my time. It's Brussels or Paris time. We have on the euro the current account. And I consider it an important news, even if it is not in red, it is in yellow. But it is an important one because when we have a big surprise on such news, we have big movement on the euro. The color code of Forex Factory, you need to know that the color code on Forex Factory is not always correct. It's not because a news is in red that it will have necessarily a big impact on the market. Most of them are correct, but not all of them. And we may have orange color or yellow color, which can induce big movement in the case of a big surprise. The current account is typically the case. The trade balance on the yen is typically the case. They are in yellow or in orange because the big surprises are not so frequent on these news release. But we have to be aware that a big surprise is always possible. So the current account on the euro is an important news, but with the economical situation in Europe, I don't feel very concerned with that news today. But anyway, so what I do is I study carefully the different news which are important, and on our website, I will show you in a moment, we indicate what are the news we consider important. Let me show you that. Just give me a moment. I'm going to display them on the on my web browser. So here, let me open a new web, our Max site, Max Trading System, Max Trading, no, trading.
Better use English, you say, Blue.
Yeah, Max Trading System.
How come it doesn't come up with Max Trading System, you say, Blue? Should be there automatically.
Yeah, because I don't have a link on
I know. Sorry.
So this is our web page, our landing web page, and then we have here the button news watch list, and every week, every Saturday, in fact, we define all the news which are important for the coming week. I will not describe all the feature of this page, but what we can see is we have for the euro current account, it is a major news release in the case of a big surprise on that news release, and we define a bias which is a bearish bias in this case. And so this means that until the news, I consider the euro will be weak, but this can change over time. And so there are a lot of features we can exploit, and then we define also a list of 10 to 14 pairs, which are the most promising pairs for the week to come. And so, so when I do that, I define some currencies where we may have possibly movement or action depending on the news release, but I also try to define some fundamental biases by reading some information on the market. And I read some specific articles in some news papers or some media on internet. And so, for example, today I have been pointed that the pound is positive, or maybe positive, but the yen also is maybe positive, which may be so a problem with the pound yen, for example. The US dollar is weak, which explains why during the ASEAN session the pound US dollar has moved upward. And the euro is, I have no bias on the euro. So positive on the pound, negative on the US dollar, very positive on the pound yen. And so this is why on the yen, this is why the pound yen is going down, or the yen is way stronger than the pound. And so this helps me to validate my entry setups in the case I have a setup, for example, with a strong pound but a stronger yen. So we should see the pair going downward. And so I will be interested only with short setup. If I am positive on the euro US dollar, because I think the US dollar is weak and the euro is neutral, I will look only for long setup. Similarly, on other currency, for example, short on the USD yen, short on the euro yen, long on the pound Aussie, and so on and so on. So these biases help me to define the direction of my setups I have to privilege. And so this is why I have just marked on, I will not take the trade, even if this is a demo account, I will not take the trade in real time. I will simply mark on my chart because I'm not allowed to call trades. I'm just allowed to explain what we do with the Max. In order to call a trade in a trading room, here in Europe, at least in the Eurozone, I need to be licensed, and I'm not licensed to do that, and I do not want to go into all the series of exams. It takes 4 years, in fact, to get the agreement to call trades. In Europe, they are very strict. The market authorities are very, very strict for that. But I can explain how the max concept may apply under some specific circumstances. And so now, when we want to trade with the max, we have to use also a template. A template showing the tools we have. For example, if I take the pound yen here, we have some indicator on the chart. These indicators have the aim to show or to give an idea of what the momentum and the volatility may be, and to have an idea of the quality of the trend we are trading, because with the max we are trend followers. I realize that I have not asked you if you hear me well. Would you like to tap a yes in the question area if you hear me well and if you see my chart correctly? Would you like to type a yes or a Y? Okay, a lot of yes. Thank you very much. Usually I ask that, and people don't hesitate to answer. So let me just check the chart here, because I see that we may have possibly an exit setup preparing for the pound yen. I will explain later what we have. With the max standard, in fact, we would have made an exit in this area. I will mark that here, but I will not show the standard template. And this exit is what we call in our max jargon a TT rejection. And so let me explain why the price is moving here. Some of the concepts we use with the max. I have said that the max is a trend following system. And what does this mean? This means that we need to define what is a trend. And so with the max, we define what is a trend and what are the movements inside that trend we want to trade. Just to make it simple, but this is not the complete rule, the trend will be downward when the price moves below our home base, which is the long-term moving average. It corresponds approximately to a 200 and exponential moving average of the close price or the medium price. And let me here scratch the trade here, and I will explain why I have made that. And when the price moves above the home base and even a home base channel, we consider we are looking for long trades. Now, a trend can be composed of several directional movements, and so typically between 2 and 3 directional movements, sometimes less, sometimes more, of course. And these are the typical movements we want to catch and to trade. And along a directional movement, we can make one or several trades. For example, one directional movement can contain typically between 2 and 3 trades. And of course, along these directional movement, while we are in a trade with the max standard, we can make scalings whenever a scaling opportunity happens, and if the risk is mastered correctly, in fact, because adding to a trade increases the risk of the resulting position. It's nice to have a position growing over time, but we have also to control the risk on that growing position. Now, in order to define the quality of a trend, we use several moving averages. I have said that our home base, which is the long-term moving average, helps to define the long-term trend. And so in order to define the directional movement and then the movement we want to trade, we use 3 smaller moving averages. The gold one here we call the momentum line, and the red and the blue moving averages, which represent respectively a 21, a 55 and an 89, which is almost 100 periods moving averages. We can ask, why do we use several of these indicators or these moving averages? In fact, when you think about that, and this is a question which is often asked in our course or when we are illustrating the max, it is often asked, when you trade in a specific time frame, and by the way, with the max we can trade any time frame. I'm illustrating here the 5 minutes because it's the smallest practical time frame we can use in a small period of time, 2 hours, to illustrate this concept, and possibly some movement if the market wants to move. So a question which is often asked is, when you have an entry setup, do you check higher time frames to validate your entry setup? And we always answer and explain that no, we don't need to check higher time frames. The 3 EMAs we have on our chart are representing what the price is doing in higher time frames. Indeed, so the momentum line, which is the gold line here, which is a small, a short time horizon moving average, 21 period moving average. So it's very close to the price action. So when the price goes down, the moving average goes down. When the price goes up, the moving average goes up, with some leg, of course. And we also add a leg, an additional leg. Indeed, all our moving averages, if I draw a vertical line on the present candle, all our moving averages are shifted. So we add a lag to our moving average. Why? Simply in order to be out of certain circumstances we do not want to trade. And we give much more details in our MAX courses. So, but these moving averages tells us also what the price is doing in higher time frame. Specifically, the blue moving average represents our momentum line in a time frame which is 3 times higher. And we can illustrate that. Let me take, for example, small segment of line along the blue balance line, that way. I don't need to be absolutely accurate. You will understand what I mean. Okay, that way and that way. And now let's switch to the 15-minute time frame, because 15 is 3 times higher than 5 minutes. And if I switch on the 15-minute time frame, you can see that my white lines are on the Mo line. Not necessarily exactly on, but parallel to the Mo line. This means that indeed our blue moving average represents the momentum line in a time frame 3 times higher. But what does this mean? And if we do the same thing with the red moving average on the 5-minute time frame, we will have exactly the same type of behavior. Let me show that very quickly here, that way, then here, that one, sorry, here, and that one here. And let's switch now to a 30-minute time, so 6 times higher. And again, we can see that the line is not exactly on, the white lines are not exactly on the Mo line, but parallel to the Mo line. And if we do that with the home base, in fact, with the home base, you would see that the home base represents the momentum line on a 1 hour time frame, a time frame 12 times higher. And so this means that the moving average we have chosen on our chart we want to trade represent these higher time frame Mo line. This has an important consequence. The consequence is the following. Let me erase these lines here. Where is my delete button? Here. Okay. So what does this mean? Another very important concept we want to our 3 moving average is to have angle. For example, when we want to look for short trade, we want to see the Mo line, the blue and the red moving averages going downward. But remember, the blue moving average represents the Mo line in a time frame 3 times higher. This means that the Mo line in that time frame 3 times higher is also pointing downward. So the trend is also downward in the 15-minute time frame. The red line represents the Mo line in the 30-minute time frame. So this means that the trend is also downward in the 30-minute time frame. And similarly for the home base. And so we have, in fact, with the angle of our EMAs, a confirmation of a downtrend in a multi-time frame approach. The price is moving downward, is in a short trend, downtrend in the 5-minute time frame, but also in the 15, in the 30-minute, and in the 1 hour time frame. And we don't need that way to check, to switch from chart to chart. Just one chart is enough. Of course, we may have the impression that the chart is loaded with indicators, but these indicators have a meaning, have a signification, a relevant signification. So it is a confirmation that the trend is in the direction we want. So the angle and other conditions, separation, correct order, are, I will not explain these concepts here, are very important to define the validity of a trade, in fact. And so, yes, the MAX is a multi-time frame approach for trend trading in just one chart. And we are using also other conditions. Another condition we use is the price modes. It is important to understand in which type of context, market context, the price is moving. And so the price can move in a trend mode, it can move in a counter trend mode, it can move in a consolidation zone mode, it can move in a tight one or in a large one, consolidation zone mode. It can move in a choppy mode, it can move in a, what we call a spaghetti zone. All these different price modes which define, in fact, the market conditions, which are important to pinpoint correct entries and to handle correctly the trade, are important. In fact, I will not go into the details here. Of course, this is the subject of the course. But here in this example of the pound yen, I can say simply by looking at the chart that we are in what we call a choppy mode. And when we are in a choppy mode, we have to handle our trade in a very, very specific way in order to optimize the probability to get a profit, even if it is a small profit on our trade. Let's look here. In this example, just after the market opened, the London Open was a few minutes before, a few minutes after, sorry, what time is it here? 10:50. What time do we have here? With the daily saving time, it's a mess with different platforms. So the London Open has been made in 26 minutes, so at 11 here on my chart. 11, so here. 11 was right on this candle. Okay, so this candle has represented the London Open. Normally, we don't trade while the market is opening. But it was just to illustrate an example of trade we can take with the MAX. So I have said that simply by looking at the chart, I can say that the price is in a choppy mode. A choppy mode, you can, just to make it simple, you can see that the price has a complete erratic behavior. There are more criteria to define what a choppy mode is, but when the price is moving with no directional bias and in a complete erratic way, we can say the price is in a choppy mode. What is the danger of a choppy mode? You can see that when the price makes a nice movement, or what seems to be a nice movement in the direction we want to trade, very soon after the price retraces and makes another movement which can completely erase the movement we wanted to trade. And whatever the size of the movement, look here, nice push to the downside, important retracement. Small push to the downside, important retracement. Nice push to the downside, important retracement. And so when we consider we have a valid trade in a choppy mode, we have to expect the price retraces very quickly. You have seen that here. So I have said here we had an entry setup, a valid entry setup, and then I have said that with the max standard level, at this point, around this point, we have an exit setup, and then I have closed the trade in this area. So this is an example, an illustration on how to handle a trade in a choppy mode, and you see that it was a good decision. Even if the profit is a small profit, the trade is profitable. How much? It's really easy to say. The number of pips taken here is 14 pips minus the spread, 3 pips, so the profit is 11 pips. So here we have what we call an MX. I will explain in a moment. So MX plus 11 pips. The entry setup was what we call here. Each entry setup has a specific name depending on the structure of the setup. In this case, it was a breakout WeMo. So I have a chair on my proximity, just a moment. Oops. Why a breakout WeMo? Because in fact we were in a concession zone mode with a support level in this area, somewhere in this area, and this was the entry setup bar for our trade. So breakout of a consolidation zone mode inside a choppy mode. And whenever we open a trade, we always consider the trade is made of 2 units. 2 units. Of course, with the max, we know how to calculate the size of these 2 units, so the size of the trade. And whenever we open a trade, we also define a stop loss. In fact, our stop loss was here and was around 25 pips. 25 pips. We have rules to define where to place the stop loss, of course. And the rules is always defined by a first place to consider where to place the stop loss, and then a second condition, which is a minimum size the stop loss must have. And the stop loss is not called a stop loss, but in fact it is called an emergency stop loss. Emergency stop loss. Why an emergency stop loss? Emergency is what do we do in case of emergency? And so what is an emergency? Whenever we trade, we have not to forget that we depend on technology. For example, here I'm depending on my internet connection, I'm depending on my broker server, and so at any moment I may have a technological problem in such a way that I will become blind to my trade. It's not a problem which happens frequently, because fortunately here in Europe and in many countries around the world we have good internet connections. But since 2008 I'm trading live. 2008 I'm trading live. This has happened to me 2 times. 2 times in now 9 years, almost 9 years, 8 years, a little more than 8 years. So in these 2 cases, and it seems to be more than a coincidence, the price went against me. And so the stop loss, the emergency stop loss, is a hard stop loss where we want to close the trade if the price goes against the trade in order to protect our trading account. And of course, along the trade, we have rules how to adjust the stop loss in order to reduce the risk we have on the trade. And at some point, if we have no technological problems, we may end with a risk-free trade. This is very important in the concept of the trade risk management. And so the price reached a level where a trade could have been opened, so we opened the trade, and at some point we have exit criteria. In this example, I have just mentioned one of the exit rules we have. We have a lot of exit rules based on, for some of them, based on technical indicators, for some of them based on pure price action, for some of them based on a combination of price action and indicators to evaluate what the momentum and the volatility is doing. We have also time exit technique, so exit technique based on time, and we have a last one we call the movement invalidation. It may happen sometimes when the price is going against the trade, when the price has reversed, that none of our exit rules apply, and so we have to define where we want to scratch the trade. And so with the MAX we have a concept called the movement invalidation. The movement invalidation is a point in the movement when the trade makes no longer sense, because there is a higher probability for the trend to reverse, even if we are not sure the trend will reverse. But the risk is important enough to scratch the trade. And so you have seen also in this case that I have scratched the trade, when an exit rule applies, we close one unit. And we call that exit technique here an MX, which means minor exit or momentum exit. We want to keep one open unit in the case the trend resumes in order to catch a larger portion of the trend and so possibly a larger profit. This happens frequently when we are in a trend mode. I have explained we were in a choppy mode, so in a choppy mode we can see that the price very frequently reverses quickly, and in such a way to even cancel the movement we have been able to catch. But we never know. The price can leave the choppy mode at any moment. It can move from a choppy mode to a trend mode with just a few bars. And if this happens, we want to have a possibility to stay in the trade, or at worst to reopen a new trade. And so we have specific ways to handle this situation. And this is why here I have applied a specific rule we have with the max in such a choppy condition to scratch the trade. And so here when we close the second unit of the trade, so when we make a final close of the trade, we call that setup an XXX, which means a final exit, and we also close one unit. And when the trade is closed, then we can define, if we want to calculate ourselves the trade result, but of course in the terminal panel we will have the result, but we can do a little more. We can calculate the number of pips of the first unit, for example here 14 pips minus the spread, so 14.5 minus the spread 3.5, so 11 pips, and break even for the second unit. So this means that our trade has made an average result. So we can write on the chart trade. So we have plus 11 pips, not a big profit of course, here a very small profit, but it is in a choppy mode. The stop loss, the ESL was 25 pips. And so this means that the reward to risk ratio, or the realized reward to risk ratio of this trade, is 11 pips divided by 2, because we have 2 units, we need to calculate the average result, and then divided by 25 pips, which represent plus 0.22 R. R being the risk we want to associate to the trade. It may be 1% of our trading account, it may be 2%, it may be any number between 0 and, for example, 2%, if 2% is our maximum risk we want to allocate to the trade. And so in a choppy mode, making almost a quarter of R is not a so bad result. And we have very frequently such kind of trades these days, because the markets are less trending nowadays for all the problems we have. So all over the world we have big problems in Europe, problems which will be worse and worse over time. We have some uncertainties in USA, what will be the reason of the Fed to increase its interest rates. There are some uncertainties based on the decisions the new president will take or will be able or would like to take. We have some uncertainties about UK with the Brexit. We still have some financial or economical problem or monetary problems in Japan. We have the big problems of the economy in China for the moment. So a lot of problems making the world a more uncertain place, and so this explains why we have also a higher volatility in the market. Anyway, very often these conditions can create some nice trade opportunities. So we have to recognize in which conditions we are in order to adapt our trading rules to these conditions. And indeed, we have entry setups, exit setups. The entry setups are defined in terms of the market conditions. We have specific setups when the price is in a trend mode. We have specific entry setups when the price is in a tight consolidation zone mode, and so on and so on. And our exit rules are defined in a very, very specific way. It's not because I use here some indicators, and I have mentioned one I'm not showing here, that we follow blindly our indicators. The indicators are just there as a tool to help us to go faster in the analysis of what is happening. We never ever attach any predicting power to any of the indicators we are using. They are simply a way to define one of the category of the exit rules I have mentioned earlier, indicators, price actions, times, and so on, which represent, in fact, something very important. An exit rule always represents a moment in time and in price when the trade is now facing a potential risk. We don't need to make any prediction. We can recognize through some conditions when the risk begin to appear in the trade. And namely, just to make it simple, and it is easy to understand in an intuitively way, let's take back here this trade here. It was a short trade. When the price reverses and begin to retrace, this of course represents a potential risk for the trade. Why? Because we never know how far the price can retrace. It may even reverse and define a trend in the opposite direction. And so an exit technique in the MAX is always a moment in time when a risk appears in the trade and when that risk is important enough to take a decision to reduce that risk. To take a decision to reduce that risk. And so, of course, in the courses, in the different level of the MAX courses, we explain how we make our exit in details. But this is the idea, this is the concept. An exit technique is never a way to predict what the price can do, but it's a way to measure when the risk we have on the trade becomes too much important in such a way we have to take a decision to reduce that risk. Okay? And we can do that. I mean, we do not need to predict what the market will do because we can be confident on the statistics we have. If you take, for example, the 5-minute time frame on any chart, and you scroll that chart on several months, several years, you will see that on average, 2 or 3 times per week, 2 or 3 days per week on average, you will get nice movement, able to produce important profit or nice profit with the MAX. And 2 or 3 days per week when the trades will be poor trades, generating small profits, generating small losses, or even break even. What we can say is for years and years and years, now the winning rate of the MAX is around 70 to 75%, and the realized reward to risk ratio, at least with the MAX standard, is around 2 to 3 hours. So we have a realized reward to risk ratio between 2 and 3 hours for each trade. This is the expectancy. This means that whenever we open a trade, we can expect to make between 2 and 3 hours of profit. What does this mean? It means that if we take a risk of 2% for the trade, and we make a 2 hours, so the risk R is 2%. So 2% times 2, it's 4%. We make a 4% profit. If we take an R and risk of 1%, this means that our average result per trade would be between 2 and 3% with the MAX standard. Less with the MAX primer because or the MAX Lite because we do not have the scaling technique, of course. Is this clear up to now about the concept I wanted to explain? And that concept of the multi-time frame confirmation through the EMAs is something you can use in any trading system, by the way. And this is why, even if this session is simply an information or an informative session, we wanted to give you something you can apply immediately in any trading system you can use. So let me move my notes here, because some other setups are appearing. Another Remo is preparing in the pound yen, but also in the USD yen, which is nice because remember I have said weak on the US dollar and very strong on the USD yen, and so which indicate a short trade on the USD yen as well as on the pound yen. But I prefer, when I have the choice between these two, for me the USD yen is more appropriate than the pound yen, because the pound is strong, and so the yen is very strong to the downside, is very strong, so going to the downside with the pound yen, but the pound is strong too. So this can limit the movement to the downside. The movement should be a bit better on the USD yen. But of course, even if I have explained that my bias was short on the USD yen, we have no guarantee that the price will indeed move downward. And you see here a setup has appeared. It is a Remo, but it is not a valid one. And our max graduate will know why. We have also a Remo on the pound yen, but it is not a valid one. We have rules telling us when a setup is valid or when it is not a valid one. And so when it is not valid, we simply skip that trade, whatever the price will do. And sometimes it's true that we will miss a nice movement. Any questions in the question area up to now?
Hi, Eusebio. Nothing has come through yet.
Okay.
They're all very quiet. And for Maxes that are out there, I've opened up the normal Max chat room. The URL changed recently, so either email me or ask for the URL through the question box, and I'll give it to you. But there's no password on it if you want to click into it. And anybody else, if you've got some questions, please ask. While Eusebio has been talking, I've been putting in some notes regarding the price modes and the higher time frames with the moving averages, which you might be able to use. So thanks, Eusebio.
Yeah. Another concept we use, I'm going to explain now. Let me first of all add some features on my chart. Pound yen. Now I can close that chart here. Every week we also define what we call max price levels. Let me illustrate that here on another pair. We'll take, for example, let's take the Euro yen, yes, here. So we had on this Euro yen at the same time as the pound yen an entry setup which was that candle, but it was not a valid one for the same reason I have said now that in the pound yen and in the USD yen we had one, but an invalid one. But we also add on the chart, we can add on the chart several price levels. And so each weekend I define these price levels on around 14 to 18 or 19 pairs, the most traded pairs in the market. And these are price levels which can be possibly so supply or demand level. For example, here we can see that the price has reached that area where we have a confluence of several price levels. It's not impossible that these levels or that area, it's a zone of approximately how many pips here? 12 pips approximately, is a demand area. If this is a demand area, this means that the price should bounce off and reverse to the upside. If this price is not a demand area, it may be an offer area or a supply area, in which case, or no level at all, in which case the price can go through them and continue to go to the downward. And so what does this mean? This means that when we have an entry setup, let's suppose just for a moment that our entry price level would have been, it is not the case, but let's suppose it would have been here. Okay? It's not the case, but it is just to illustrate. This means that knowing that we have a possible demand level here, we are facing a problem. The price can reverse at that level. So what is the potential movement we can see here? It's around 22 pips minus the spread. And the problem will be for the trader is that minimum movement large enough to make the trade worthwhile to be taken. And so it's up to the trader to answer yes or no, depending on his own or her own risk averse. And then to handle the trade consequently. And so when the trade is open, he has or she has to observe closely what the price is doing on that level. Then we can see that the price has not bounced off, but has crossed that level. The price has reached the next one. We are in the same area, in fact, so the price can reverse at any moment. And so now the price is facing the third level. We don't always have three levels. We sometimes have just one level, or sometimes two. Sometimes the distance between these levels are larger, sometimes they are smaller. But anyway, we know where, in the case the trader is in a trade, where he or she will have to put much more attention to what the price is doing, and to have in mind all the exit criteria in order to handle the trade very carefully. And so these levels add another dimension in the market. Where are the price levels where the big boys can possibly take action in order either to take some profit or to induce a movement, to create a movement in a specific direction. If we look, for example, on the pound yen, the price has indeed reversed, but it was not a tradable situation for us. And you can see that the price has indeed crossed these levels and has bounced off from the next level, so here. Okay? And now the price seems to bounce off. This does not mean that the price will reverse, simply that the price is retracing. And where is the next possible zone of interest? It will be in this area. If this level or if this area becomes a supply level, it may be possible that the price will reverse and resume the downtrend. In which case, if we have an entry setup to go short in that area, that if the setup is a valid one, we will be able to take another trade. Let's have a look to the Euro Yen, the Euro US dollar. Here we see exactly the same thing. The price is preparing to create a setup. We are in a complete choppy market, but you can see how the price has a tendency to respect some of these levels. Sometimes not, but sometimes the price will respect some of these levels. Look here, that brown or orange level here, the price has bounced off. It may possibly cross somewhat the line before reversing, and look at that magenta line, how the price has also respected here, somewhere here, and now the price has crossed that level. And if the price comes back higher and define an entry setup, it may be an interesting setup, because the next level will be far enough here. So we have more than 30 pips movement, potential movement. The price can move, can possibly move. We are never sure the price will reach that level. We are never sure the price will bounce off from that level. It may also cross that level. It may reverse before. But these are at least level of interest as potential supply and demand for each pair. And these levels are different for each pair, of course. So now we have to wait for another entry setup to appear. So I expect one on the Euro US dollar, I expect one on the pound yen, I expect one on the USD yen, and I expect one on the pound Aussie. Yeah, Mark, there are a lot of ways to trade, and it depends also on the market. In UK, you can spread bet, of course, which is very interesting, because I think you pay no tax on your profits. Unfortunately, fortunately for you, here in Belgium and in France, I pay taxes on my profits, but I do not want to move in a country where I don't pay taxes, because I like these two countries. So So the love of the country is higher than the hate of the taxes. And of course, in our Max courses, we explain how to define the entry setups. We have with the Max Standard 7 entry setups, so there are 7 ways to open a trade. We have around 20 exit techniques. We have a very strict trade risk management. I have shown an example here with the pound yen in choppy mode. Well, so now we have to be patient and wait for the next opportunity. So if you remember, I have said at the beginning of this session that with my daily preparation routine, I came up with the following bias: positive on the pound, negative on the US dollar, very positive on the yen. So the euro, neutral on the euro. So this gives a set of currencies we can use to define the pairs we want to monitor and so trade. And so we can make any combination: the euro pound, the euro US dollar, the euro yen, the pound US dollar, the pound yen, the US dollar yen. And you can see on my chart that this is exactly what I have made. I have chosen 5 of them. I have not chosen the euro pound. The euro pound is an interesting pair to trade because it makes more regular movement, but they are smaller movement, but fortunately with a higher, a larger pip value. And so the smaller movements are compensated with a higher pip value, so the profits are very similar. But it's a pair you need a lot of patience to trade. And so this is why it's extremely rare. Personally, I trade the euro pound, and so I prefer to pair a higher volatility pair we have in our top 10 or top 14 pair. I like, for example, to consider the pound Aussie or the pound Kiwi, or the euro Aussie, the euro Kiwi, to complete my list of pairs. So I like to monitor between 2 and 8 pairs, rarely more. At the same time on the 5-minute time frame. Of course, on the daily time frame, I monitor many more pairs. In fact, I monitor almost all the 28 pairs. We will see if the price will bounce off from that white level on the chart, on the pound yen. But it will give a setup. If this candle ends as a red candle, it will not be a valid entry setup for the max. Oh yeah, Mark, you pay tax on goods, of course. Here too. you cannot avoid VAT. Now, a new potential trend is starting on the euro-US, but we need to wait for a valid setup. And so, in fact, what the max is in fact a trading method where you can see on each of my charts I have that label patience and disciplines. We wait more often than we trade. We have to wait for the perfect conditions to trade. On the 5-minute time frame, during the European and the US session, we have between 2 and 4 opportunities to trade. 2 and 4 is large enough per pair in that small time frame. Let's say, for example, 3 opportunities per day on average for 1 pair. If you monitor 6 pair, you can count on around 18 opportunities during the European and the US session, which is way more enough to trade. More than we can physically handle. Have I the level on the USD yen? I don't know if I have them. Let me check. It would be interesting to see them. No, I don't have the USD yen. Sorry for that. Yeah, and in 2 minutes we have even in 1 minute we have the news release on the current account. So now when we are facing an important news release, so let me draw on the chart here a vertical line when we will have the news release. I'm used to mark my news release on the chart not with an indicator but with a vertical line. And so for example here I will write euro current account. I do that during my daily preparation routine. So here on the next, at the open of the next bar. And so when we are facing an important news release, so there are two situations. Either we are in a trade or we are not in a trade. And so when we are not in a trade, we never open a trade, a new trade, if a setup appears, an entry setup appears during the last hour before the news release. And if we are in a trade, we do not keep the trade opened during the last half hour before the news release. So these are the two rules we use when we trade a small time frame. Now there are some news, and this is explained in our website. There are some news which are to be considered in the small time frames. For example, if we take let's see today if we have one such example. No, tomorrow we will have, for example, on the pound, the retail sales month over month. It is an important news release if we trade small time frames, from the 1 minute time frame up to the 1 hour, even the 4 hour time frames. In higher time frames, that news release has no impact because the movement we may have in the case of a surprise are not big enough. When we have a news which can have a larger impact, we indicate it by the indication H4+. For example, the euro, the current account is such a news release in the case of a surprise. Now let's see if we have the result, because the news has been released. So here, the current account, you see 24.1 billion instead of 29.3 billions. On our website, if you remember, we had, where is, oh, I should have opened it in a different website. You see here, bearish. That bearish bias is valid only until the news release. Now that we have the news release, the number is worse than, where is it? It was here, current account. Sorry, I have to redisplay it. It's worse than the forecast, and so normally we should see the euro weakening. Now, is this a big surprise? It depends, perhaps yes, perhaps no. We explained that in our Max courses, how to define what is a big surprise. And when you observe what the euro is doing, the euro US dollar is doing here on the euro US dollar, on the euro yen, we can say that the reaction is not important, so the big boys do not consider it is a big surprise. So we may have some movement, but I do not expect to have a big movement due to the news release. Now, when we have a big surprise in a news release, we will see very often a high volatility in several, if not all the pairs. It depends on the news. If you consider a Fed announcement with an interest rate increase, for example, which would be unexpected, or a big surprise in the non-farm payroll, you will see all the pairs moving, all the pairs moving. With some news, only a few pairs will move. If you take a news like tomorrow on the pound with the I don't remember the sales order or something like that. We have a news on the pound tomorrow. This is typically a news release that in such a way that if we have a surprise on that news, only the pound pairs will move. And so if we trade a pair like the euro US dollar, we can ignore that news release. I never use an indicator to display my news on the chart because these indicators usually slow down MetaTrader. And when I trade with my MetaTrader platform, I trade with several platforms, it depends on my broker. I want to have my platform as fast as possible. You can see on the euro yen, the movement the price is doing. So with a euro which becomes a bit weaker and the yen which is still very strong, it's not a surprise to see the euro yen going downward. But we have to wait for a valid entry setup. So no setup here on the euro US dollar, no setup on the euro yen, nothing on the pound US dollar, no setup on the pound yen, no setup on the USD yen, and no setup on the pound Aussie. Any questions? Okay, I see a question by Richard. How do you determine when to enter and exit a trade? Is it based on levels or do you have indicators on the chart that assist with entries and exit? No, the setup, you have to recognize visually the setups. Each setup is defined with a set of rules and conditions, and so we don't have trade assistant. We are making a lot of thinking about that aspect. Chris, for example, is working a lot on how to create a trade assistant to show us on the chart when we may have possibly either an entry setup or an exit setup. Now the levels are used differently. The setups, the levels are used not necessarily as an entry or an exit level, but to define, as I have explained here, with this is not a real example, but just to explain the concept. Once we have an entry, what is the potential movement the price can make until the next level? And if that distance is large enough, we can define different types of criteria to decide when the movement is worthwhile to be traded. If this is the case, we can take the trade. If it is not the case, we simply skip the trade. Okay? And once we are in a trade, these levels can indicate potential level for a profit taking. Possible because it's not automatic. We never use entirely automatic decisions to handle our trade. The MAX is essentially a visual trading system. Many aspects of the MAX can be automated, not all, or some aspects are completely difficult to automate, but we have always to be guided by that important concept, which is the trade risk management. In fact, whenever we consider to take a trade or when we are in a trade like the one I have explained here, we have to always focus on the risk we are ready to take and on the risk we are facing while in a trade. What time frame chart do you use? Tony, personally, I use myself a 5-minute time frame and a daily time frame. I have trades on the two type of time frame, but every time frame can be traded. We have max traders who like to trade with the 15 or the 30-minute time frame. There are a lot of them who like to trade with the 4-hour time frame, or even with time frame like the 6 hours or the 8 hours or the 12-hour time frames. They build offline chart with their custom time frames because in fact there is when we trade, there is never something like the best thing. There is never a best moving average. There is never a best level. There is never a best time frame. At any moment, you will always have a best time frame for a specific movement. But that best time frame can be the worst time frame a few minutes or a few hours later. Every time frames works similarly. And of course, it's true that we have a tendency to make much more profit with a smaller time frame simply because we have more trade opportunities. I will explain that in a moment. But the time frame must be carefully chosen by each trader in order to fit, and this is important, in order to fit the trader's constraint. For example, not all the traders are full-time traders. You may have possibly another normal job, what we call a 9-5 job. And there is nothing wrong with that, of course. And so this means that you don't have a lot of opportunity during your day to check your trades or to check the market. And so you need, because it would be, it may be delicate to check the market while you are working. If you are your own boss in your company, that there is no problem, of course. But if you are an employee, it may be risky because you have rules in your company. And so you need to consider the time frame which best fit your constraint. And I have mentioned just the job, the normal job, but you may have other constraints, for example, family constraints, or you may have other activities you want to have. And so you need to choose the time frame which best fit your constraint. And it may be a higher time frame. Once you have chosen your time frame, then you trade the time frame as any other time frames. Edith asks, sorry for the question, but where can we find the indicators, especially the right upper corner green and red color ones? You mean this one, Edith? This is an indicator which is called the signal bar, and you can find it very easily with simply Google it, and you will find it. You can find it on the forums of Forex Factory. You can find it on the forum like TSD, and it's free. And it's a free indicator. In fact, almost all our indicators are free indicators. Of course, the moving average are free, are by default in the MetaTrader platform. But you can see also, let's consider here the pound yen again. We have Bollinger Bands in yellow and in green line. That indicator is not standard indicator of MetaTrader. It is the standard indicator we have a little bit tweaked, we have a little bit modified to answer our, or to make it doing exactly what we want to do within the max. We have other indicators which are, for most of them, for example here the stochastic of the RSI, it is a free indicator. We have a lot of other indicators which are free. In fact, there are just 1 or 2 indicators which are specific to the max. And we provide them, of course, for free with the course. We provide all the indicators, we provide the template, and so you get them after each training session. With the Max Standard, we have 7 training sessions, and with each session, we enrich our template with some new tools, and of course, at the end of each session, we provide the new updated template and all the necessary tools you will need to build that template. Okay? But most of them are free indicators we can find by either in the MetaTrader platform or by using Google.
Hey,
Google is your friend, as I'm used to say. Yes, Chris, please.
I've just put the link to the signal bars in the chat area, if anybody wants it.
That's fine.
Yep. And also, Tony asked a question just above edits, and he asked, will not higher time frames affect your stop levels?
So what is it? Will not a time
okay.
frame affect your
So-
stop level? Yeah, of course, of course, indeed. Let me explain something. I will take the US dollar yen here. Okay. We have no setup for the moment, so we have to wait. But let's suppose we get a setup, an entry setup to go short. And let's suppose that for the trade we are considering, the rule tells us we have to place our stop loss there, for example. Okay? On that place. Above the blue moving average. Okay? Let's suppose we have a rule telling that. We are here in the 5-minute time frame. Okay, 5-minute time frame. Now let's switch to, let's say, the 4-hour time frame. If we have a setup in the 4-hour time frame and the rule is to set the stop loss on the blue moving average, we would set our stop loss, for example, here. Okay, depending where our entry setup is located. And so the rules are the same for all the time frames. Why? Because what we want to do when we are in a trade is to have the same risk for each trade. When we consider taking a trade on one time frame, and let's suppose our risk is, let's say, 1 hour, or let's say 2%. Let's say risk 2%. Okay? This is our R. The size of the trade with the max depends on where we have placed the stop loss and depends also on the risk we take per trade. This is what we call the position sizing concept. Position sizing concept. And so in a small time frame, the price is moving specific movement. We will have specific stop loss, for example, 30 pips. If we trade a higher time frame, for example, the 4-hour time frame, the stop loss will be larger because the movements are larger. It may happen that the stop loss will have a size of, let's say, 4 hours. We will have a stop loss around around between 200 and 250 pips because the movements are larger. But we want to have the same risk per trade, 2%. What does this mean? This means that whatever the time frame we trade, we have rules to place the stop loss in such a way that if the price reverses and hit the stop loss, if the trade is closed on that initial stop loss, the maximum loss we will have will be 2%. Now, this happens in the very worst scenario when we have, for example, our internet connection going down, breaking, when we lost it, and we are blind with the trade, and the price reverses and hit our initial stop loss. Now, in practice, we never close the trade on the initial stop loss, but this is the maximum risk we consider. And so we want to have the same risk whatever the time frame. And because the movements are larger in a higher time frame, the stop loss must be larger also on the higher time frame. And this is why we use position sizing. The risk is the same whatever the time frame. And of course, the stop loss will be larger in higher time frames. Okay? It may be, for example, it may be 500, 600, 800 pips on a daily time frame. Okay? But it doesn't matter. What matters is how to calculate the trade size depending on the size of the stop loss and depending on the size of our risk. Of course, the consequence of that is with a higher time frame, because of a larger stop loss, the trade size will be smaller. But the performance will be always the same per trade. The only difference we will have is the number of opportunities. We will have many more opportunities in a 5-minute than in a 4-hour time frames. And this is why, in fact, when you compare two trading systems, you are often told note that when you compare trading systems, you have to compare their expectancy. Expectancy. What is the expectancy? The expectancy is the average result per trade. You take, for example, 100 or let's say 200 typical trades, 200 trades. Among them you will have winning trades and losing trades and break-even trades. You take the total result of these 200 trades and you divide by 200, you will have the average result per trade. This is the expectancy. And you need to have a positive expectancy to have a profitable trade. Okay? Now, the expectancy is not enough. Let's suppose, I have said that with the max standard, we have an expectancy per trade between 2 and 3 hours. Let's say 2 hours. Okay? This means that if you make 200 trades, you will have a result of around 400 hours. And you can predict that result with large samples of trades. Now, what is the difference between a 5-minute time frame and a 4-hour or a daily time frame? If you consider a period of 1 month, with a 4-hour time frame, you will have perhaps 10 trade opportunity, and in the 5-minute time frame, you will have 50 or 60 opportunities to trade. And so in the 5-minute time frame, you will make a total result of approximately, so 2 hours times, let's say 50, 2 hours times 50. This means 100 hours profit for the month, okay, in the 5-minute time frame. And in the 4-hour time frame, I have said 10 opportunities, so you will have 2 hours. 2 hours times 10 equal 20 hours. So you may have the same winning rate, you will have the same winning rate in the 2 time frame. It's not exactly true. In higher time frame, you will have in general a winning rate which will be a little higher. But the frequency of the trade in the same time period is important. You will make many more financial profit with a small time frame than with a higher time frame. Okay? But the problem is, are you able to trade a small time frame? Isn't it wiser in your own personal situation to trade a higher time frame? So the expectancy is not enough to compare trading systems. You have also to take into consideration the frequency of the trade you will get with the trading system. Okay? Well, I see that one of our Max graduates has made a nice trade. That's good, Jan.
Yeah. Eusebio, I was going to bring that up with you. It looks like he entered just on the London Open, and prices moved down around about 50 pips on the euro-yen. But he's managed to, can you explain how he managed to make something like 100 pips out of it?
Okay.
Yeah.
Have you made a scale-in, Jan?
I think he did 2 scale-ins, Eusebio.
2 scale-ins. Yeah. With which level of... with the sum.
ETF.
Okay. The ETF, the sum ETF. Yeah. Okay. With the max sum ETF is the highest level of the max we have, and we use another chart representation. And so this helps our max grade to make an entry, for example, let's say here. I think it was, no, here, somewhere here. And
right there.
along the trade, he has been able, for example, I just give a suggestion that way, perhaps a scaling in this area, and perhaps another scaling, for example, in this area. For example, the scalings are well defined, and then the trade has been closed, let's say, somewhere here. Okay? And so one entry, 2 scalings, and potential MX level. I can imagine, for example, an MX here. So most probably the scaling was here. And then
You said sorry, but we're doing the jargon thing, so you better explain what an MX and a scaling are.
Yeah. I have explained what the MX is. When we have an exit technique, we always close one unit. We open a trade with 2 units, we close 1 unit at each MX, and a scale-in, we add 2 units. So, for example, here we have 2 units opened, we close 1 unit, we reopen 2 units, we close probably here 2 units, or 1 unit, sorry, and then we reopen 2 units, for example, here, and then at that point we are left with how many? 2, 4, 6 open units minus 2 closed units. So 4 open units. When we make our XXX, we close the 4 remaining open units. And when we add the pips taken by each unit, so 1 unit from this entry to that level, the second unit of this entry from this entry to that level, this is a certain number of pips. Then we have from that scale-in 1 unit closed here, so some pips, then here for the second unit, and then for the last scale-in we have the 2 units closed here. So we add up all the pips made by these 2 units, and he has added a nice result of how many pips? 100 pips. 100 pips with a stop loss probably around, I don't know exactly, around perhaps 15 pips. 15 pips size. So this represents a little more than 3 hours profit. Am I right, Jan? 3 hours, a little more than 3 hours? And he says, yes, correct. Okay. So we have, with the max, we have 5 levels, the max primer, the max standard. Then we have the max advanced. Sorry, we have 4 levels, in fact. So the max primer, so the max 5 levels, the max primer, the max light, the max standard, the max ETF, and the max advanced, and the max SAM ETF. Here I'm considering the max standard, and so I cannot use these most advanced features. So let me explain the difference now between these 5 levels. With the max primer, which is our most basic level of the max, it is a level of the max for which we use simply 2 entry setups and a few exit techniques in such a way, and it is really priced very, very, very low, but you will get more information next Saturday during our marketing presentation, in such a way that you can get a good idea of who we are and if the max is a trading system which is really worthwhile. Then with the max light is between the max primer and the max standard. We add a few more entry setups and a few more exit setups. And then we have the max standard. With the max standard, we introduce the scaling technique, how we can progressively add to a valid trend while controlling the position risk in such a way to have always a situation when in the worst case scenario we do not face a risk, an important risk. And then we have the max advanced. The max advanced level goes way, way, way deeper into several concepts. First of all, with the max advanced, we consider also how to trade counter trend movement. For example, on the yen, when the euro yen here will reverse, with the max advanced, we will be able to define when we will have an entry setup in a counter trend movement, and with the possibility for that counter trend to become an uptrend. Another feature of the max advanced, we go way deeper in the way to exploit the news release, and we go way deeper in the trade risk management and in the money management to extract more profit from the same movement. And I also teach a very important concept, which is what I call the discretionary situations. What is a discretionary situation and how can we exploit that? When we follow our rules, concept and rules to open a trade, to close a trade, we will get some result. But at some point along the trade, we can decide to deviate a little bit from our rules. That deviation is what we call a discretionary situation, but it cannot be made in a subjective way. We describe precisely when we have a possible discretionary situation and how we can handle it. And the key concept behind that idea is the trade risk management. Because it is key, a discretionary situation must never add unnecessary risk to our position. And so this is what the max advanced is. And then the last level of the max, which is the max sum ETF, is a way to generalize, in fact, the movement we can trade, and with that level we have around, if we consider the 5-minute time frame, we'll have between 3 and 10 opportunities per day during the European and US session. And we have many more opportunities to trade, and along a trade we have many more opportunities to scale in and to scale out. A scale out is equivalent to an MX. And so generally we increase importantly the expectancy of each trade. So these are the different levels of the max. I cannot show all the levels here, but anyway, you get an idea. You see here on the price level how the price is nicely bouncing off on the white level. The color of the levels are not necessarily relevant. When I define these price levels during each weekend, I use to go faster in the way to pinpoint these levels. I use different time frames, from the 1 hour up to the monthly time frame, and we have a color code to recognize them. For example, the white level corresponds to the 1 hour time frame. The 4 hour is represented with, I think it is the orange level. Then we have a magenta level, which is from a daily time frame, and so on. But they are all important. Simply, the time frame helps us to better, easier pinpoint them. And when I define, let me take, for example, the daily time frame here. When I define a level, I always draw on my chart from which point the level has been defined. And so we are here. So all the levels we are seeing here have been defined last weekend. They are not adjusted during the week, so they have been defined during the weekend, and sometimes so they start way before the weekend I have used to define them. And they stay valid during the week, and I will readjust them next weekend. So this is simply the meaning of the colors. And so as I have said, and as you are seeing here, because we have very strict rule with our max primer or max standard level, sometimes we can miss a nice movement. This was a nice movement we have missed with the pound yen. This was a nice movement we have missed with the euro yen. This is a nice movement we have missed with the euro US dollar. But this is the price to pay with the max primer and the max standard in order to have safe trades with a 70-75 winning rate. Now with a higher level of the max, like the max ETF, I cannot show you the max sum ETF here, so I'm going to show you the max ETF. Let's consider here the euro yen. I'm going to delete all these lines. Delete. I think I have deleted the level. It is not a problem. We have a specific tool which defines our ETF movements, which is called here this one. I will use an 8-period setting, and here orange. Okay. And so in this case, so we have delete all selected here. So in this case, so I have added a specific tool we have. I explained in our MaxSum ETF course what these lines are. They are very specific to the Max. You will find them nowhere else than in the Max. And in this case, we had, in fact, our entry, probably here, I need to make a zoom in to check more carefully. No, not on this candle, but on this candle, here we had our entry setup. So before 10 minutes before the London Open, in fact, with an entry somewhere here, right on the, just after the London Open. And so this corresponds, and it is not strange, of course, to the entry our Max Graduate has taken for the trade, and then we would have been able with the Max, I show only the ETF component, I don't show the sum component. With the sum component we have many more details in the price because we are using a different price representation. So we have a nice entry. The trade is still valid up to now, but we have many more opportunities to scaling along that movement, in fact. So with the Max ETF and the Max Sum ETF, we have many more opportunities, and usually larger movement and smaller stop losses, making our reward to risk ratio larger when we get a nice movement like this one. When we have a movement starting around the London Open, or around the US Open, or around the Tokyo Open for Asian pairs, so pairs with the yen, the Aussie, or the Kiwi, and when the movement is more than 50 or 60 pips, which is the case here, 50 or 60 because it depends on the volatility of the pair, we call that movement a true trend. A true trend. And when we have such a true trend, the advantage of such a true trend is, depending on how the price is moving, we know with 75% probability when that movement will exhaust. With 75% probability. And so this is a great help, a great guideline, first of all to stay in the trade, and then to know when to close the trade, when to consider closing the trade. Because 75% probability, knowing where the trend will exhaust, or at least not the trend, but the directional movement inside the trend, is high enough to keep confidence inside the movement. Can we get the indicator enter to the link, but no download? Chris has said the link, sorry, yeah. And okay. Ian, exit maybe too early, but with Eusebio I have distraction, so better to close after, even we look for another trade. But yeah, indeed, when I trade myself, I am extremely quiet, extremely calm. I shut up even. I close my radio. I don't have the TV since 1998. I hate TV. I close my internet browser and I focus only on my chart. I don't answer the phone except for one or two people. So because I want to focus on my chart, my specific chart, in order to never miss a movement, to never miss an entry or an exit setup, in fact. And so we are now in the phase when we have to wait patiently for another trade, because the price is now retracing on the euro US dollar, on the euro yen, on the pound yen. On the pound US dollar we have still nothing. We have to wait. We don't have a trend starting. We have to wait for the pound Aussie to the upside. We have a nice retracement forming in the USD yen, and so we have possibilities for a new entry setup short on the euro US dollar, euro yen, pound yen, USDN, but we need to wait for the appropriate conditions to possibly open these trades. But on some of the pairs, the pullback are now deep enough, so this is the case on the pound yen and on the USDN, to consider a potential setup when the price will come back, if it will come back, of course. And when this will be the case, we will have to assess the validity of the trade. We have a tool, also we call the Max Trade Monitor. I will show that on the second open house day. I think it is next week. Let me check on my agenda. It is, yes, next week on Thursday the 30th, and for the US Open, yes, for the US Open, and I will illustrate, because I will no longer give all the explanations I have given today, but I will illustrate an EA we call the Max Trade Monitor, which helps us to make very easily, in a one-click, our entries and exits. Oh, here in the USD yen, we have that entry setup forming. Let me check if it is a valid one. No, it is not a valid one. So we have strict rules to define when we have a valid setup or not. Here I can say it is not a valid one. Based on the max primer, based on the max standard, let me check on my other platform if we have a valid setup here. No, it's not a valid setup. We have a lot of conditions telling us that the setup is not a valid one. So we still have to wait. Perhaps the next candle, it depends how the next candle will close. If it closes as a blue candle, so this means that we don't have a good opportunity yet. If it closes as a red candle, it will depend. Indeed, in a downtrend, a setup is always a red candle, so a candle closing lower than the open, and in an uptrend, a setup is always a blue candle, so a candle closing above the open. Maybe a setup coming here in the pound yen and in the euro yen, but we have to wait for the close of this candle in around 3.5 minutes. Generally, when we have some angle in the price movement, like we are seeing in the euro yen, like we are seeing in the pound yen, I don't say a steep angle, but some angle, and the price is retracing, generally the first red candle we have, for example here, let's take the pound yen. Let me explain something else. With a retracement, we can always draw a trend line, which is a support level, that way. Okay? And what we observe very usually, I don't say this is the rule, but very usually our entry setup candle will be a candle breaking that trend line, very often. But it is not necessarily always the case. If the angle of the previous movement has been too steep, even if it is not a steep movement, the first candle breaking the pullback of our pullback will not be a valid entry setup, because the conditions for an entry setup, a valid entry setup, are not fulfilled. And this is not a surprise to see, for example, that now on the euro yen, the pound has a tendency to continue its pullback. Not convincing in the pound yen, and now we have a blue candle on the USD. So the pullback continues, in fact. Maybe a potential setup in the euro USD, but we have to wait. If it closes as a red candle, we will have to check the conditions. If this is the case, it will be a setup we call a safe and perfect move. but we have to wait for the candle to close. We always wait for the candle to close in order to assess a potential entry setup, and we see that if this is a valid entry setup, we have enough place to take the trade compared to the stop loss size we will have. So patience and disciplines are the two main virtues we ask to our max traders. Attendee 1906, yeah, I think that Chris has answered your question. That indicator here is called, I'm going to show it here with rectangle. Here is called a signal bar. Let me write it on the chart, the name of the indicator. Signal bars. And it's an indicator which exists for years and years and years on MetaTraders, and you can find it very easily by Googling. And so Chris has given the link a little earlier in the question area. So scroll in the, you have found it. Edith has found it, okay. So scroll in the question area and you will get the link. But if you Google it with the keyword signal bar, you will find it easily. There are several versions, version 7, 9, 10, 11. I like an old version. The version I'm using is the version 7 because we have all these small rectangles I call status, which are well separated, and so it's easier for me to check what is happening. So now let me check here the pound yen. So on the pound yen, we have a new bar opening. We have to wait for this candle to close, and then we will be able to assess the validity of that candle as a potential new setup bar. And so the signal bar gives the status of three indicators, a MACD, a Stochastic RSI, and a moving average on all the time frames. A red color indicates that the indicators in the specific time frame is going downward. For example, the MACD in the 4-hour time frame is downward, and a green color means upward. So in the 5-minute time frame, the MACD is going upward. The yellow, and so you may have light red, bright red, light green, dark green, so you may have some nuances in the colors, but this is not important. And yellow means neutral. And so we have a specific way to use that indicator in our methodology. And so the idea is the following. Whenever we have a potential entry setup bar, we have to check several conditions. We have three types of conditions. We have a first type of condition, which is a technical condition. So the setup must, or the pattern must fulfill some conditions, and among them we use the behavior of all our indicators. We call them tumblers. A tumbler is a favorable element, and we have a specific conditions on these tumblers. We have then a risk condition. We define a way to measure the risk we have on that entry setup. It is not the potential reward to risk ratio or the loss we want to make, but the risk we associate with our trade setup is the setup correctly patterned. And if this is the case, we will say that the risk is appropriate. Otherwise, the risk is not appropriate and we skip the trade. And then we have a third type of conditions, which is the global context conditions. Is the setup in agreement with the global market conditions? I have said at the beginning of this session, we had a strong yen, pound, but a stronger yen. So normally the pound yen is downward, and so based on fundamental analysis and based on the news releases, and so in this case, based on what has happened today, my short bias for the pound yen is still valid. And so if all these three types of conditions are fulfilled, then my setup is valid and I can take the setup. There is still another last condition we have to fulfill to check is the stop loss. Sometimes the stop loss is too large, and when the stop loss is too large, it becomes worthless to take the trade. Because with a too large stop loss, if you have followed what I have explained previously with the position sizing concept, with a too large stop loss, the trade size will be too small. And so the result you can extract from such a trade becomes worthless. It's a lot of work for no profit or too small profit. I want to be well paid for my trade. If the pay is too small, if it is a poor pay, I don't want it. I want to be paid for my time and for my efforts. Max, I must disagree. TV, a great distraction for grandchildren. And you see, it's not because we see the price seems to reverse, as it was the case with the euro yen, with the euro US dollar, with the pound yen, with the USD, that we have to rush to take that trade. We need to wait patiently with the correct conditions. And so it was too early, the price, finally, it's still pulling back. Now, with the MaxSam ETF, it may happen that these counter trend movements are worthwhile to be traded. Let me check some of them. No, I see nothing really worthwhile to take a counter trend trade. No, this means that I don't see any conditions for a counter trend trade for the moment, so we have to stay with, for the moment, with the same trend. Now, when the price reaches the momentum line, remember the gold moving average, which is a 21 period moving average, exponential moving average of the close price. It is called the momentum line, or MO line in abbreviation. When the price reaches the MO line, so this means when the price touches or crosses the MO line and comes back, so if the price resumes the down movement, we call that situation a trend resumption. A trend resumption, and this is a good place very often to expect a new trade to happen. But indeed, we still need to wait for a valid setup. This is something interesting in the pound Aussie. In the max standard, we have a special counter trend, or similar to a counter trend entry technique, which is appearing here in the max in the pound Aussie. But we still have to wait for the close of this red candle, which will happen in a little less than 2 minutes. If this is the case, we may have an entry setup to go short. The trade will be a bit risky here, depending on what I'm seeing on the chart. It will be a bit risky, but perhaps it will be worthwhile to be taken. We have to wait for the bar to close, because the nature of the bars tell us if among other conditions, the setup is valid or not. So let's keep an eye on that setup, on the chart. In our max jargon, if this setup is a valid one for our max graduates who are in the group here, it will be a PMO, a pseudomo. And you recognize why. But it will depend on that candle. If this is the case, the stop loss should be placed somewhere here. And for the entry, it depends where the bar will close. I'm going to check with my higher max level, my higher max level template if I don't see any counter indication. No, I don't see any counter indication. So this is, let me recheck quickly. No, we have no counter indication. So here we have what we call, in fact, a pseudomo entry setup. The entry is here. You see the price has hit my entry level. The stop loss size is with a spread of approximately a little less than 3, but let's count it as 3 pips. So 26 pips plus 3, 29 pips. So we have a stop loss size of 29 pips. ESL. pips. So when I have said that with the max we are essentially a trend following trader, it's relatively, of course, to the trends defined with the home base. Here you can see that we are entering while the price is in a counter trend mode. The price is moving above the home base. So usually we will look for long trades, but we have a very special entry setup which sometimes appear as a counter trend trade, and it is called a pseudomo. Pseudomo. Mo means momentum entry. So we have a lot of conditions to fulfill, to check in order to assess that that setup is valid. So with some use, with some practice, we can go very quickly. I have said that this setup presents some risk, so we have to pay a lot of attention, but the risk is not large enough to neglect that trade. And so let's see how that trade will move on. We still have a few minutes in front of us, so let's see if I have some levels on this chart. The pound Aussie. Where is the pound Aussie? Here. I'm going to add my price levels. Pound Aussie here, and I will copy them on my chart I'm trading. So here, that way I can close the chart and I can come back here, and I can see here that I have a first level here just above the home base channel with a distance of 22 pips, 23 pips. So 20 pips after the spread. It's a distance which is worthwhile to consider to take that trade. And if the price crosses that level, we have another one after our home base channel, which is a good point, and the next one will be way further. So this is one of the indicators. I said we have a small risk on that trade, but still worthwhile to be taken. With our max ETF, the setup would have been on this candle here, this one, or this one. So for an earlier entry of 17 pips, 15 to 17 pips. So the MAX ETF allows earlier entries, generally, and generally with smaller stop losses. So this contributes to increase the reward to risk ratio. On the other pairs, the price is still pulling back, possibly with the price, here, coming back on the pound yen. It is the only one which presents a potential interesting situation, but we have to wait for the candle to close. Have you noticed that trade, Jan, on the pound Aussie? Ah, okay, you follow the pound Kiwi. Yes, it's a good choice too. I have hesitated this morning between the pound Aussie and the pound Kiwi. And sometimes I have both of them. Kind of minimalist, yeah. You're right. When we are fully concentrated on our chart, it's very easy to follow several, with some practice of course, to follow several pairs. There is not a problem at all. You see, I have said a bit risky, that trade, and you see immediately what is the effect after the candle I have used for the entry has closed. The price is now beginning some retracement. And this is why when with the MAX methodology we perceive some risk on a possible trade, and there are several types of risk we can see on a chart, on a potential trade, we can decide to skip the trade, or if we are not afraid to face a small loss on the trade, then we can take it. So the new bar opening on the Euro-Yen, Euro-US dollar, possibly the pound-US dollar now, and the pound-yen may give other opportunities to trade. It will be, let me see here on the Euro-US dollar, it should be a safe and perfect more on the Euro-US dollar, a re-more on the Euro-Yen, a safe and perfect more on the pound-US dollar, a re-more on the pound-yen. My bias, which has not changed for the pound and the US dollar, was positive on the pound, negative on the US dollar. So normally I'm interested only on long trade on the pound US dollar. And so this is a setup specifically on the pound US dollar. I will skip. This is one of the global context condition which is not in agreement with the trade. And so I would skip that trade on the pound US dollar. Let's have a quick look on the pound yen, which is the most promising pair at the close of this candle in 1 minute. So I would place my stop loss somewhere here if we have a valid setup. No, it will not be a valid setup because we have a very important detail. If this candle closes as a red candle, we have a specific feature on the chart in this area which tells us it cannot be a valid setup. We will have to wait for the next candle. We will have to check the next candle. The name of that feature is called a hook, but I will not explain it here what a hook is. The detail is given in the Max courses and how to handle a hook situation. I would like to show you a losing trade, to show you that a loss is always a small loss. Let's check here. On this candle, no, we don't have an exit setup bar yet. Not yet. If this present candle closes as a blue candle, we will have an exit setup bar. But we have to wait 4 minutes for that. And you will see how this, in the case of a losing trade, this helps to reduce, importantly, the loss on a trade. On average, I have said that the expectancy of a winning trade with the Max Standard is around 2 hours, between 2 and 3 hours. A loss, so the average loss when we have a losing loss with the Max is around, usually around minus 0.5 hours. Sometimes it can be a little larger. It can even reach sometimes 1 hour, but that's rare. So the loss is always small compared to a winning trade. In fact, to have a positive expectancy, this means that our profits are larger than our losses. A loss is always very small. What time is it? It is 11:07. We are at the end of our 2-hour session. I propose to wait for the close of that candle. If it is a blue bar, we will have an exit setup bar. I will show you how I will consider to make an MX, and I will show you, in the case this trade will end as a losing trade, that the loss will be a small one. So nothing else on the other chart. So let's focus on this one. Because we have losing trades, of course. If we have 70-75% winning trades, we have around 15, sometimes 20% losing trades. And we have to be happy with these losing trades. We have to embrace them. They are part of trading. And so this is an illustration why I'm going to explain it in another way. So we have 15 to 20 losing trades, okay? In some circumstances, we can avoid these losing trades. So we have a lot of tips telling us that we have risky situations for the trade. I have said we have for that trade some risk. It is a riskier trade. If you remember what I have said at the beginning of this session, I was long on the pound. I have not mentioned the Aussie. So when I don't mention currency, this means that I am neutral on that currency, but strong on the pound. And so normally I should concentrate on long trades with the pound Aussie. And this is a short trade. This is an example of a risky situation. I have illustrated exactly the same situation on another pair. I don't remember exactly which pair. Yeah, here, the pound US dollar, where a potential short setup was appearing, but I have explained I would skip it because the bias was to the we had a weak US dollar and a strong pound, so we have to focus on long trade, so ignoring short trade. So we have exactly the same situation here, and so this shows, for example, how sometimes if we don't pay attention to all the criteria, we may have a losing trade. And so now the setup, the bar has closed. We have here an exit setup bar here. We always indicate an exit setup bar with a magenta vertical line. And I will make my MX, not an XXX, my MX in this area. So if the price reaches this level, I will make my MX. Okay? Now let's make some risk analysis. If this MX here is activated, I will close one unit. Okay? That unit will lose here, how many pips? We have 11.5 pips plus 3 pips, so 14.5 pips. Let's write it on the chart, minus 14.5 pips. Okay? And then we will be left with another open unit. And the second open unit, will be closed on the next exit technique. It depends where the exit will come. But let's suppose that the exit will appear. It depends what the price will do. Let's suppose the worst risk, the worst situation. The worst situation is for the price to continue to go upward and hit the stop loss. So on the stop loss, we will have a full loss on the unit. So minus 29 pips. Okay? Which obviously will not be the case here because the price seems to resume to the downward. So my total loss will be how much? 29 and 14.5. This means minus how much? 33.5. Okay? Which represent a reward to risk ratio, a negative one, so we have to divide.
It's 43.
Sorry?
It's 43, Eusebio.
43?
Yeah.
Okay.
I hope so.
No, 58. 0.58. So in the worst case scenario, that loss will represent minus 0.58 R. Not 1 R, so around half R, as I have explained previously. And this is in the worst case scenario if my first unit is closed on this level I have indicated by that small white line, and the second unit is closed on the stop loss. Now, whatever will happen if I close my first unit at a better price, and if I have the opportunity to adjust my stop loss, my result of that trade will be obviously better than that reward to risk ratio. And it may even be positive. But as we can see, the price movement is not convincing to the downside. The result will be most probably a small result. But anyway, we already know the maximum loss we will make on that trade. Right on line with now you are, oh, how can I make such an error here? 43. Oh, thanks, Chris. Thanks, you are completely right.
Yeah. I know you said.
So,
I know.
Yeah, so the loss is a little larger indeed. I was feeling something wrong, and so 74, yeah. So a little larger than the half R, but still a small loss, okay? And either the unit number 1 or the unit number 2 close with a better result, we will make a result better than this worst case scenario, okay? And so this is why, in fact, with the MAX, we must never, ever fear to take a losing trade. But it is important to pay attention to all the conditions to avoid as many losing trades as possible. I have illustrated here why we should have avoided that short trade. Remember, I have explained it was a short trade, but a risky one, okay? Among them, there are several tips here telling us that the trade was risky. One of them is the global context. Okay. Any questions before we wrap up? Because it's time for me and I have to close my activities of the days and to make a trip in France. So we are seeing some setups appearing on the short side for the pound yen, for the euro yen, for the euro US dollar. So you can check your chart to see if the price will move significantly to the downside. Any questions before we wrap up here? Feel free to ask any questions, so we are at your disposal. Thanks, Edith. Thanks, Fiona. I see we have female traders. We have in our group several female traders, and the ratio of the female traders having success is higher than the ratio of male traders. So it seems that a female trader is more adequate to trade, usually. Thanks, Gerard. Oh, thanks, Jan.
And just a reminder, everybody, we've got an intro webinar this weekend at New York time, 3:30 p.m. Saturday, about an hour. You can ask lots of questions there as well. And next week, sorry, I don't have the time with me, but we'll be doing the New York session live as well. And if you have any questions, let us know on that side of things. And all this is in preparation of our 53rd series of courses coming up. We've got about 1,800 people that have gone through the MAX, have done the courses, and like I said, this is our 53rd series of courses with all the MAX and the Prime and the Light and ETF, etc. So if you have any questions about that, let us know. And also on the weekend, if you do watch the intro webinar and you haven't done a course, there's a possibility you could win a course as well. So just a little bonus there, but you have to sit through the whole session. So sorry, nothing's free, but yeah, you can get a free course out of it. So thank you very much for attending.
Yeah, and by the way, just a last recap, we have a setup bar forming, but we have to wait for the close of that bar on the euro yen, on the pound yen, on the US dollar yen. So it may be possible that the market will move. Again, nothing, of course, never a guarantee for that. We never know. We have always to wait for the candle to close in order to define an entry setup. And while we are in a trade, we have to handle it, knowing most of the time what our maximum loss will be in the case of a losing trade. I hope next week, I will be able to show you also a more interesting winning trade. It depends the movement the market gives us, of course. I will use possibly the ETF level with a simplified template to show you that the movement we can get are larger and what kind of result we can get. And I hope to show you also a more standard trade with losing trade, not a counter-trend trade like this one, to show you again, I can always explain that a losing trade is always a very small loss, easily recoverable with a winning trade. So that being said, I see no other questions. So thank you very much for your questions, for your participation and for your question. I always appreciate when there is some interaction during these presentation sessions. Of course, I cannot explain everything. These are the subjects of our courses, but we can explain some of the concepts, and I hope that the concept I have explained with the multi-time frame approach we use with our moving averages will be helpful for you. This is something you can use in any trading system, even scalping with scalping trading, by the way. So I hope you will appreciate, and on that, so I wish you a great rest of the week, a great weekend, and see you either Saturday or next Thursday for the second open house live session. And in the meantime, bye everyone and take care.